From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for November 21st, 2025. Let's start with the Packers. They're home at Lambeau this Sunday with the Minnesota Vikings. Your Milwaukee Bucks are home for games with Detroit on Saturday and Portland Trailblazers on Monday. To get into the holiday mood, the city of Milwaukee kicks off the season with the Christmas tree lighting tonight at 5. So as soon as this podcast is over, we'll be running right down there. Tomorrow, Saturday, the Dome's holiday show gets underway, and the Deer District Holiday Market will run through the rest of the month. Okay, let's start with DoorDash driver Olivia Henderson. According to a New York Post, Olivia was making a delivery to the residents in Oswego, New York. And you know how delivery drivers like to snap a photo of the package once it's delivered. Well, the door was wide open when she arrived, and she filmed the customer passed out with his pants around his ankles along with his underwear. I bet this was not the tip she was looking for. Australia scientists have unearthed crocodile eggshells from 55 million years ago. They belong to drop crocs. That's drop crocs, a crocodile species that climbed trees and pounced on unsuspecting dinner. This would have made a great Crocodile Dundee film, and made a little bit more fun and exciting. And if you were with us last week, we told you about Kim Kardashian failing her law exams, and now she blames ChatGPT. In her review of IA, she says, "They lie, and they're always wrong." Well, Kimmy, you can kiss that product endorsement deal goodbye. On the podcast today, we have Art Rothschild, Steve Giles, Joel Dresang, and with a wrap-up of the week, here's Kyle Tetting.
And what a wild week it was, Max. The NASDAQ down 2.7% this week. That's down 628 points, closing on Friday at 22,273. The S&P down 1.9%, closing at the bell at 66,03. And the Dow also down 1.9%, despite a 493-point rally on Friday for the Dow. Still down 902 points for the week to close at 46,246. For the year, NASDAQ up 16, the S&P up 13.5, and the Dow up 10.2. Perhaps the up numbers are the place to start, despite a wild week and down for the week. Still up for the year. We've had some meaningful selling pressure, I think, pushing back against what's been such a strong rally this year. Felt like maybe we'd get some reprieve from some of the AI-focused selling Thursday morning, as NVIDIA reported Wednesday afternoon. And all of a sudden, after what had been a decent start to the day on Thursday, we got one of the wildest intraday swings toward negative on Thursday we've seen in a very long time, really going back to April of this year in the tariff conversation. And then on Friday, all of a sudden, a rally back the other direction. It very much feels like volatility's back. It's here to stay, at least for a little while. All kinds of reasons why, but perhaps a little more from you, Art, on just what we saw this week and maybe how we fit it all in.
Yeah, it seems so normal to me. I know it seems so normal to you. Volatility is something we deal with on a regular basis. It's why we manage money the way we manage money. The issues this week were very similar to the issues back in April. Tariffs sort of crept in as part of it. But even more so, the uncertainty regarding artificial intelligence. Nobody really knows, if the companies that are buying all these chips from NVIDIA, so even though NVIDIA is making all this money, but then they invest in these companies that are buying their chips. It's very incestuous. And so a lot of questions being raised about the ultimate results of all this investment. And quite frankly, I think investors just took it as an opportunity for some profit taking. The other thing that was in play this week was finally we get some numbers on employment, and it was a good number, so everybody started to doubt whether the Fed is going to lower interest rates in December. And they don't know, but the market's betting on it, and this is increasing volatility. So I think this is just a perfectly normal week, and quite frankly, it's still a tremendous year. The fact that we're up 17.5% perhaps at the end of October, now we're up 12 something or 13 and a half on the S&P 500. Still a great year. Investors who are long-term investors, as we are, appreciate the fact that volatility is just another opportunity to shift things around a little bit, add a little more to the game if you're so inclined. And let's not forget about the importance of bonds in a portfolio to smooth out the rides when this type of thing happens.
Art, so how is this volatility similar to the one in April?
It's the uncertainty, that was caused by tariffs. This time around, quite frankly, it's a little different. The key operative term here, again, is uncertainty. This time, it's with respect to something that we're not going to get a resolution of. We're not going to know what the Fed's going to do with interest rates. And furthermore, if the news is bad, that's when they lower rates. So it's not really a good thing. You mentioned that in our show notes, Kyle. This time around, the target, I think, is different. But the uncertainty back then was caused by tariffs. And there's still a question with respect to why is the market going up when tariffs, regardless of the fact that they're lower than proposed in April, are still a drag on our domestic economy and a drag on the global economy. So nothing's really been resolved this year, but the market's up over 13%. I think I'm sticking with the fact it's a tremendous year.
I think you add to that I think at certain points this week, but even looking back over the last month or two, we've even been uncertain about what we're uncertain about, if that's fair to say. And some of that goes back to the tariff conversation, and we're still waiting on a word from the Supreme Court on whether or not the way they were implemented is even allowed. I think you add in that magically NVIDIA had a great earnings number, and when you look at what that means for kind of the bigger picture on AI, well, short term it was a positive, and then all of a sudden investors started asking, but didn't we already price this in? And I think that's part of the conversation now is we've been talking for a while about how it's going to take not just consistent and stable earnings, but it's going to take some real earnings growth to account for the kind of rally we've seen in the stock market. That's what we're forecasting. Certainly there are some pretty strong earnings growth forecasts out there. But again, when you're already counting on that, I think the kind of euphoria that comes in the wake of those earnings reports is tough to really see come beyond just a pretty small pop here and there. And then you add in that employment report and what it meant for the bond market. We saw these wild swings, not just in stock prices, but also in expectations for what the Fed is going to do. And so, Steve, historically we count on that fixed income piece as kind of the ballast, the more stable part of the portfolio. Despite some of those wild swings and expectations for the Fed, it was actually a fairly quiet week for bonds overall, and maybe a reminder on why we own them overall.
Yeah, bonds are up year to date, anywhere between 5, 6, 7, 8%. For those of us that can remember what fixed income was paying way back in the 80s, 90s, and early 2000s, it's nice to see that the fixed income piece of our portfolio is participating again in terms of total return. I've talked a lot recently with clients about the idea we refer to as the regression to the mean, where if we think of the mean as the average return on whether a stock or a bond. The fact that bonds have come through this period of a lost decade from the end of the global financial crisis in 2009 up until COVID, and rates were really, really low. Everybody was being able to borrow money to buy cars at 0% financing, and you weren't getting paid anything at the bank. CDs weren't paying anything. To now have your fixed income finally giving us the kind of yield that we would expect from fixed income. This might be the case for a while, especially in an environment where we look at stocks being overvalued, we look at the market in general as being somewhat expensive. Bonds could be a much bigger player in a diversified portfolio moving forward for that reason, Kyle.
Art, it's probably hard to point out just how strong of a year it's been for bonds. It's a lot easier to write about the great stock market year. It's a lot easier, I think, to write about how more speculative assets like gold, silver, or especially Bitcoin and the cryptocurrencies had been doing so well. And then you get the last month of kind of shock to the system where those really speculative assets like Bitcoin all of a sudden tumble. Not fair to say, hey, we told you so, but certainly we've urged caution in those kinds of areas. But I think it's hard to really drive home the point in a market like this, just how well bonds have really done.
Yeah, there's a great article in the Wall Street Journal on Monday talking about the fact that this is the best year for bonds since 2020, which is a good thing. But it's not, bonds are the thing we use. It's really for mature audiences. We put it in portfolios. Young kids want to make a lot of money. They put it in the stock market, and over time, they're going to do great. The older we get, the more we want a smoother ride. It's like my grandma driving a Cadillac or a Buick or something like that. You don't need a sports car. As you get older, you need something that's going to get you somewhere, maybe an all-wheel drive, vehicle. And so when we're talking about good returns for bonds, it's not sexy like the stock market where we're up 13.5 or whatever on the S&P or 15, 18, whatever it is on the NASDAQ. It's a steady ride, 4%, 5%, as Steve mentioned, 7% because you get some gains because interest rates have come down. And then there are the nuances. We talk about tasting whiskey or wine or something like that, the nuances of bonds. Shorter maturity bonds are going to give you a steadier ride with less ups and downs if interest rates, or as expectations with respect to inflation and interest rates vary. Intermediate term bonds are hopefully going to make you a little more money with maybe a little less or a little more risk. And we tend not to go too far out on the yield curve because there are always going to be questions about what's going to happen long term to inflation, the budget deficits that this country is running, the huge national debt could result in expectations for inflation going higher, not to mention the fact that inflation has gone higher. So if we don't hit the Fed's target, of 2%, they may raise that target to 3%, and then you'd expect the expected return on long-term bonds to go higher. And so you can lose money in bonds. So we're very careful about the way we use bonds. But what a great tool to smooth out the ride for older investors, especially, and for all investors to the extent you don't want to lose your money.
And not only smoothing out the ride, but as an income generator for those
Absolutely.
who need to take withdrawals from their portfolios.
Joel, hard not to notice that amidst all the kind of new volatility in the stock market, some of it's certainly tied to some economic data we're suddenly seeing again for the first time in a month and a half. Helpful, obviously, to have information, but at the same time, when you haven't seen it for a while, I think some bigger shocks to the system sometimes. Anything in particular stand out to you?
Kyle, just that. It's some of this stuff is dated, but we haven't seen it for a while. So you and Art both pointed about, responses to the jobs numbers. Those were numbers from September, and we're in November, and we're almost in December, for Pete's sake. So it was actually, and the headline number was positive. It beat expectations, whatever that means. But it was 119,000 jobs added in the month of September, and which was the average monthly addition for the previous 12 months. But if you just look more near term, they revised numbers for the 2 months before that, and it showed that August actually lost jobs. So that was the second out of 3 months in which the nation actually went backward in job creation, and that's the first time that's happened in years. Since the COVID pandemic. But then you dig a little deeper beyond that, and that positive 119,000 additional jobs, I look at things like the number of temporary jobs, and that's usually a harbinger of hiring. And that was down to the lowest number it's been since 2012. That's a long time. Wages were beating inflation. That's good. We also showed that in the household survey that the unemployment rate went up to 4.4%, which was the largest unemployment rate in 4 years. There's mixed message there because some of that went up for good reasons because more people were looking for work, and that just shows that maybe there's some encouragement from people who are sitting on the sidelines hoping to find work, but they're not finding it.
Yeah, I think if you feel like you can find a job, you're more apt to go look for one than if you're just so hopeless that you can't. But data from consumers, for example, on consumer sentiment, pointing to, hey, people still don't feel great about kind of conditions out there.
The mid-month reading that we got from the University of Michigan's Consumer Sentiment Survey showed that one group that was still pretty high on the economy was stockholders. And now with a couple of weeks of losses, those people are now a little dimmer in their views. And they showed that, that people are more worried about their personal finances, keeping up with prices. They're more concerned about, they're still concerned about inflation. So there are still some things to overcome in the economy.
And a pretty delayed report on trade deficit, looking back to August and seeing that we still have a pretty big gap between what we're sending out of our country and what's coming in. Not often looked at all that closely for kind of the broader economic implications, but it matters.
The broader implication is that trade deficits matter because they detract from the gross domestic product, which is our main way of measuring how big the economy is and how fast it's growing. And so year to year, that number was down 25%. But it's really hard to read, again, because of the volatility within the tariff, the trade policy situation, not knowing how long these tariffs are going to stick, what exactly is going to happen with them, how they're affecting prices, how they're affecting exporting and importing.
And I would point out that we still watch the housing market pretty closely. We had some news on existing home sales. Again, probably mixed, but some signs that maybe mortgage rates having come down a bit are helping.
Right. Yeah, the National Association of Realtors came out with their numbers on existing home sales, which were up 1.2% in October. They were up 1.7% from the year before, but they're still on par with last year, and 2024 was the slowest year for home sales since 1993. So we have to be careful with that.
Always we do. I think, Steve, one other thing worth pointing out, we're entering kind of capital gains distribution season for the year. A strong reminder that there are going to be any number of stock mutual funds that are likely to pay out capital gains. How do you talk to clients about kind of the expectations around that? But more importantly, maybe an encouragement that it's not all a bad thing when you get those gains.
Yeah, mutual funds are required to pass through their gains to shareholders each year. We get that at most of the time at the end of the year, in the fourth quarter. And because the market is up, a lot of the numbers that we're seeing in terms of estimates from these mutual fund families have been in the 5, 6, 7, 8% range. As an investor, you can do a couple of things. One, if you're paying estimated taxes, know what you're getting paid in December so that you can account for your estimated payment come January so you don't get penalized. Two, if you don't want to liquidate that particular position at some point in the future and trigger your own capital gain, which may be quite substantial, you can instruct your clearing firm or the fund family to pay out that capital gain in cash so that you're not having it reinvested. Obviously, if you want to free up some money, there's only a couple of ways to get that cash from your mutual fund investment. That's to sell it, which would trigger your own capital gain, or tell the fund family to just send you the capital gain without buying more shares. You're still going to pay in one way, shape, or form, but most of the time taking that distribution in cash, if you've got a lot of capital gains that are very, very low in terms of your basis and you've held the position for a long time, taking the cash might be a better idea. Another way, and we'll get into this in our next program here for giving, is maybe you can donate some money to offset what might be some high capital gains this year. Tax loss selling also, Kyle, is another way to address that, but we don't have many losses this year like we've seen in past years. I think investors are just going to have to grin and bear it and recognize that the market's up this year. We've made some money. If you're paying tax, it means you're making money, and that's not necessarily a bad thing.
Yeah, it's always funny when we're apologizing that we haven't lost enough for you to have places to sell to offset the gains. I think a good problem to have, certainly the way I talk to clients about it. Most importantly, appreciate you plugging next week's podcast. I think one of my favorites to do each year as we kind of get into all the ways that you can help those organizations, those people that are most important to you in your life. And so please tune back in next week. Tell your friends. We look forward to doing the show for you each week, and we will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.